We go. Hello, everybody. Welcome to the Wealth Boutique, our summer webinar series. We're diving into some of the behind the scenes tools that we help with tax strategy and financial planning. We have with us Eric from Assetmark. He's going to dive into our tax management overlay. We touched on a little bit with our last webinar here. So I'm going to hand it over to you, Eric, to go into one of our favorite tools that we utilize at the Wealth Boutique.
Yeah, absolutely. Definitely one of my favorite as well too. And it's great to be back to discuss this because it's one of our most successful wealth services programs, both from a results perspective and also how many clients and advisors have added the program to their clients' taxable accounts or their non-retirement accounts. So I'm going to share my screen here a little bit. And we're going to go over, kind of how the program works and what kind of scenarios, whether it's on a daily basis or, maybe some individual kind of situations that you guys may have where this can be really impactful and helping you guys keep up more of what you earn at the end of the day. So I will start from the beginning here. Perfect. Okay. So looking at the results, programs like TMS have historically provided 1% or more of annual tax savings in the last year. The average tax savings for an Assetmark client was 1.42%, and in 2024, the average was 1.29. When you hear annual tax savings, that is an investment portfolio concept that refers to the additional value generated by implementing tax-efficient strategies like TMS that leverages tax loss harvesting. For taxable account, what ultimately matters is the after-tax return, or the investor gets to keep after deducting taxes on capital gains, dividends, and interest, or as I said to start the presentation, it's all about keeping more of what you earn. We're going to go over some of the benefits kind of for the go-tos of it. One is going to be daily tax loss harvesting, which this program provides and how that differs kind of from previous tax loss harvesting. Smart tax withdrawals. So if you need to withdraw some money systematically or on a one-off basis, how we can do that a little smarter. And then tax transition analysis. This would be for, let's say, you have assets off the platform. We know that working with these advisors here are your absolute favorite, but some of you may have some money somewhere else and you want to be able to move that over in a way that's not going to be hit you too hard negatively from a tax perspective. Or you may have an individual position that has done really well, has a lot of embedded gains, and kind of introducing that position into your account to be able to unwind it tax effectively and further diversify your portfolio. So getting into the next slide here. So what is tax loss harvesting and how does it work? Well, let's go over an example. We have an example here. Say Microsoft falls 5% from when you bought it. In the TMS program, the security is eligible to be harvested if it's down 5% or more. So TMS is looking for daily positions in the account that qualify to be harvested. Hypothetically, let's say we had $25,000 in Microsoft and the position fell 5%, let's just say on a bad earnings report, and the position would then decrease by $1,250 or 5% of $25,000. When we sell Microsoft at that 5% loss, we now have a $1,250 worth of losses that we can now use to offset $1,250 worth of gains in another stock or position in our portfolio. Say another tech name that's maybe done really well, like Apple or NVIDIA. I'm kind of picking on Microsoft as a software company because those haven't done quite as well. Now, when we sell Microsoft to book that $1,250 loss, we can't just buy Microsoft back the same day or even the next day or the next week. To be able to be eligible to keep that $1,250 loss, we have to wait 31 days to buy Microsoft back. This is known as the wash rule. You can't buy the same security back at a loss within 31 days. If you're wondering about selling a position that has a gain and buying it back, that rule, the wash rule, does not apply in that situation. You can buy that back right away. And the reason for this is the IRS doesn't care when you sell a position for a gain because you're paying them taxes, right? So at the end of the day, they care about getting their money. And when you sell at a gain, they get the capital gains from that. So you can buy the position back whenever you want to. But when we sell a position for loss, we obviously can't buy it back right away. So what do we do from that extra cash from the sale from Microsoft to harvest that loss? Well, instead of being out of the market for the next 31 days, potentially missing out on some really good returns, what we're going to do is we're going to replace that Microsoft position that we sold from the cash proceeds. We're going to buy an ETF usually or a replacement security. In this situation, we'd likely buy a tech-focused ETF, maybe like a QQQ or something like that. And then after 31 days, we can then sell the ETF and then buy Microsoft back. So this type of portfolio management really wasn't available before technology automated the process. Years ago, this had to be done manually. So it was only really for ultra high net worth investors who had teams of people doing this for them. But technology really is a great equalizer. Now this tax strategy is beneficial for investors. If you really have $100,000 or more in taxable accounts, this can be very beneficial in terms of that after-tax return. So, but even with teams of people, ultra high net worth clients weren't getting tax loss harvesting every day. It was usually done at the end of the year once they kind of had a better sense of what their tax situation was going to be. But TMS, on the other hand, it never lets a loss go to waste. And it looks at opportunities to book losses, throughout the year. And this is a lot of times more than investors realize how many opportunities there are, particularly in the environment we've been in for the last 3 years. We've seen really great returns, but we've also seen bouts of volatility and some really good opportunities to harvest losses. Some examples of that this year would be the war with Iran. We saw, the market fall quite a bit in March. We saw that actually a year ago, the same time last year with the tariff tantrum, with uncertainty around that. But we were able to book losses, and then we were able to, those recoveries happened pretty quickly. Looking at the tariff tantrum last year, it was about 3 months until we were back to where we were after about an 18% drop from the market high. Same with the war in Iran. That was temporary sell-off, and now again we're up to all-time high. So we're taking advantage of those losses, but still able to provide some really nice returns. So this is kind of like a nice Goldilocks environment. Goldilocks meaning, obviously, the soup that's just the right temperature. We're kind of in an environment, we're in a great temperature for tax loss harvesting. Just looking at returns. So let's look at the S&P last year. We had a return of just under 18%. We had about 2 pullbacks of 5% or more. We also had that in 2024. That's actually pretty common to have, 1 or 2 pullbacks of 5%. Even 1 pullback of 10% a year is pretty common. But when we look at it at the individual stock level, it gets a little interesting. On average, about 5 stocks are down. We're down 5% or more on a daily basis in the S&P 500. So when you look at it from the index level, or owning, just the S&P, maybe in an ETF or something like that, or a mutual fund, there's only a couple good periods to harvest. But when you own more individual stocks and more lot levels, the levels of opportunities can be more frequent, especially when done daily. And this can really kind of benefit, more for, actively managed equity SMA accounts where you may own 75, 100, 125, maybe even 150 names in the portfolio. So almost on a daily basis, there could be an opportunity to harvest. And this chart here also really kind of explains, kind of what we've been seeing in the market and why it's been such a great environment. And 2025 numbers are very similar to 2024 and 2023. So what this is telling us, these blue charts, bars here, I should say, looking at this number, this is the percentage of gainers in the S&P 500 in 2023 and 2024. And we saw similar numbers in 2025. So you have about 2/3 of the benchmark that's up for the year, but you also have about 1/3 that's down for the year. So again, being able to offset these positions that have done really well, particularly some of those artificial intelligence names that have had, really, robust returns. But you don't want to pay taxes on all of that. Obviously we want to minimize the tax burden of that. So we've been able to offset some of those gains in the portfolio with these losses. And when you look at these more, actively managed equity SMAs that I mentioned that could have 100, 125, even 150 names. I mentioned last year the average, savings for clients in our program across our, thousands and thousands of accounts that are enrolled, it was 1.42%. However, for people in that type of strategy I'm describing, where you own that many individual positions, you're talking as much as over 2% in after-tax returns due to tax loss harvesting and efficient tax management last year. So, this is becoming a more popular way for investors to get access or exposure to, the S&P or different equity investments while doing it in a more tax efficient way. So I may just stop here because I want to make sure if there's just any questions on tax loss harvesting before we kind of get into the second portion or benefit, the tax smart withdrawals.
Any question? I don't see anything in the chat.
Perfect. Let's keep it marching then. So tax smart withdrawal. So occasionally you're going to need to access this money, particularly if you're not working anymore, you're in retirement, and you're going to need to use this to supplement your income. Well, what traditionally had been done at the account level in this first option is basically what they would do is they would just take your account and they would just sell everything evenly, all the positions or pro rata. The problem with that is it lacks precision and having a good tax efficient outcome. Because again, I mentioned some of those artificial intelligence names, they have a lot of gains to them. And rather selling that position the same amount as another position in a portfolio, we may not sell any of that position or maybe a smaller amount. So then that way we're getting you, let's say you have $1 million in your non-qualified account for just even numbers and you need 100,000. We're going to provide that 100,000 in a more tax efficient way. Now, what we're not going to do though is just look at it and say, how can I raise 100,000 and not pay any taxes on that, even if that is an outcome? Because remember, we also need to keep in line with the objectives of the portfolio. We don't want to get the fixed income to equity portion out of whack, have increased risk. So we are going to do it within the guidelines of the portfolio and what your goals and objectives are and your risk tolerance, but doing it in a smarter way where we can strategically look at multiple accounts and sell things maybe at a different balance between one account versus another to do that more tax effectively. So just a real quick example on that 100,000, if you had two accounts, they would sell everything evenly between the two accounts, raising 50,000 between the two, where with the TMS method, we're more likely to sell more from one account and maybe less from another account. So we don't have to sell as much to get that withdrawal of 100,000 for you. Or if you're requesting 100,000, the taxes you're going to pay on that 100,000 is going to be lower than it would be if we were just to sell everything evenly. Really not looking under the hood and seeing how we can do this in a more friendly way to you. So this is a great way that if you need money fast, this really helps your advisor. They just don't have to panic and just say, how am I going to get this money to you? They have it enrolled in TMS and they know that they're confidently providing it to you in a way that doesn't impact your tracking error. And that's kind of what I was mentioning, the allocation of the portfolio. We don't want to impact that too much, but we'll do it in a way that doesn't impact and saves you more money. And then lastly, as I had mentioned, doing transition from holdings, maybe, off platform, or if you have a concentrated position, that's something that we could, work with you guys on in terms of providing a roadmap to how we would look to, transition those assets over. What you need to provide your advisor is the holdings that you have. So the tickers, the quantity of those tickers, and then the cost basis. And then we would also need your tax rate, because when we factor in the proposal how much in taxes it's going to cost you, it's important that we get your short-term tax rate for capital gains, which is going to be your ordinary income rate. Then there's going to be your long-term rate. That's going to depend on how much your income is. For individuals making over 500,000, I think it's joint making over 600, you go from a 15% long-term gain to a 20%. So in this case, it's actually factoring in the highest tax rate. So for the ordinary at the 40.8, that's 37 federal, which is the highest tax bracket rate, and then the 3.8% net investment income tax. And then for this long term, same thing, 20% federal. That means this person is in they're paying 20% given their income. And then again, the 3.8 for the net investment income tax. And this particular person doesn't have a state income tax. I live in the great state of Illinois. We have a 4.95% flat rate. Some states have progressive rates. So again, more of the reason why this needs to be more accurate. And then we'll get into this a little bit. This is kind of a tougher kind of component to explain, but we're going to do our best. You also pick a tax sensitivity, and this will help kind of determine how much in taxes you're going to realize during the initial transition. But what's great here is whatever you pick, the medium, the high, the very high, we're going to show what each will look like. So you don't have to pick it and then be married to it or not see the other options. You can change the sensitivity whenever you'd like to, and you're going to see all the options there. And then you can do other customizations as well too. Say you want to omit certain sectors, or maybe you work for a company and you have a lot of stock in that company. You can omit that stock from the from the proposal. That way, just making it more customized to exactly the experience you want. So when we run the proposal, this is something what more or less that would spit out. What we're looking at is transitioning over just over 1.1 million, about 1.142 million is the value of the portfolio in this example down here. And we're looking to move it into a profile 5 strategy, or more something focused on growth. So what I like to do here is kind of when I see this initial transition is I like to look at the two ends here, the poles. I like to look at, this is if we were to transition your assets over from somewhere else and there was no TMS on it. So this is taking all the tax penalty to move it over here to your better group of advisors. And you'll see that in this example, they're paying over 200,000 in long-term gains, 106,000 about in short-term gains. So when we factor in their tax brackets, what they're going to owe to Uncle Sam is going to be over $106,000. But we're going to transition over the entire portfolio, right? 98.8%. If you're wondering what that 1.2% is, it's cash. So that is a overlap position. So almost 100% of the portfolio. Then we get to the very high. So with the very high, this is picking a tax sensitivity. And what this is telling us is kind of how you want us to transition the portfolio over and what your kind of main objective is and what your focus is. Now, if your biggest concern is paying as little in taxes while transitioning the portfolio over to this new solution here, very high or high might make more sense for you. Now, you're not going to transition over nearly as much as the portfolio. Instead of 98.8 or almost 100%, we're only going to be transitioning about 14% of the portfolio over to our end destination. But you're going to see look how much less we're paying in taxes. We're going from paying over $106,000 in taxes to paying just over $15,000 in taxes. So that's great from a perspective we're not paying as much taxes. However, there's always a trade-off for everything, right? Which is why I like this little balance beam. Because what TMS is trying to do, and this is, where it maybe gets a little complicated, but we're trying to solve for two problems, right? We're trying to have you guys pay as little amount in taxes. We're also trying to get you from your existing portfolio to the model, right? And to the solution that we want over here. The problem is how the seesaw works is that if we want to track the target model as fast as possible, so the seesaw comes down, we weight it down here, we're going to pay way more in capital gains like we saw over here, because we're selling out of everything and we're going to have to realize all those gains. Conversely, if paying as little in capital gains is our big priority, it's going to take us longer to get to the model. And that has a consequence to it as well too, or a trade-off, however you want to look at it. And that trade-off is, instead of being closer and tracking the performance of the model or our end destination, we're going to have some variance within the performance of the portfolio. And that makes sense because when we look at this portfolio analysis, this would be the first day of kind of trading. So we would turn over, so 14% would be, turned over day one, but still 86% of the portfolio is not the same as this model. And because of that, you're going to have tracking error or deviation or a difference in performance because the two aren't the same. And as you'll see, the different sensitivities that you pick, it's going to transition more of the portfolio over. It's going to have less tracking error, but then the trade-off for that is you're going to pay more in taxes. So in the high situation, we're going to reduce our tracking error, which basically means this plus or minus 1.82 or plus or minus 3.53. That means 66% of the time, the portfolio, when we transition about 24% over, it's going to perform within plus or minus 1.82% of our end portfolio destination. So some people may say, well, 3.53, I like that I'm paying less in taxes, but that's too much variance for me in the performance, and that makes me a little uncomfortable. But, I'm comfortable paying 24,000 in taxes for the high and, significantly decreasing my tracking error from 3.53 to 1.82. Well, in that situation, the high might be a better option for you. And then over time, what this will do is based on the sensitivity that you picked, it's kind of a math equation where we're trying to get this tracking error down to zero, ideally. What the system is computing to itself is okay, well, to lower the tracking error of the account by 1 basis point, or to go from 3.53 to 3.52, how much am I going to have to pay in taxes to lower this? And the threshold is going to be different for these different sensitivities. For the very high, that threshold is going to be higher, right? The amount you're going to have to pay in taxes to lower the tracking error by 1 basis point, you're going to pay less in taxes, less of a threshold, say, than the higher medium, where to lower the tracking error, they're willing to pay a little bit more in taxes to get closer to the model. So it kind of depends on what, kind of, scenario you want. But let's say, it's an IRMA year for you, or there's certain years where you really need to keep your income to a certain amount. And sometimes for proposals, this number is higher. So let's say none of these, sensitivities work out for you, where you're like, I can't pay 15,000, or let's say it's 50,000 for the high, very high. And you're saying, I can't pay 50,000. It's an IRMA year for me. I want to make sure my medical costs are going to be lower. I can't realize this much income. What should I do? Or what can I do? Well, we can customize it. We could put in a gains budget. So we can say, we can set the short term to zero, which in some cases is very applicable, because that, as you recall, I said, is you get taxed at your ordinary income rate, so a higher tax rate. So if you want to not have realized any short-term gains in the portfolio, you can set that budget to zero. And then you can set the long-term budget to a number that makes you feel more comfortable. Now, the lowest you can set it to is 1,000. That'll essentially cut trading off for the most part. You'll still get tax loss harvesting, but we're not going to realize any, we're going to really minimize the, the gains that are realized in the portfolio. But say you can handle 25 or 35, 40,000 in gains, you can then put that in the budget. And so that way, you're still getting the experience that you want, but we're also in line with your budget and making sure that we're not, realizing too much in taxes for you, and making sure that you're not in a harmful tax situation by realizing too much income. So this is a great way to really have control over that transition of assets, or a single concentrated position where you're trying to unwind it. And, kind of getting back to that tracking error, that's where you would see a higher tracking error. If you have one position that is an overweight in your portfolio, well, certainly there's more volatility potential there, because it's such a heavy component of it. So that's part of this trade-off, where if you want the highest sensitivity, you're okay with some of that, volatility, because your main goal is to, have a minimal tax bill. So, or in some cases, you may want to realize some taxes and then, get a little more into the model and make sure your performance is more in line with it. So this is where you can work with your financial advisor, and, kind of figure out the best avenue based on all your different things that you got going on, in your very busy and complicated lives. And one thing I always like to point out, in case, because taxes are hard to talk about, while we really like this program, it is hard for people to understand, especially kind of the first time. What we do realize is people understand, kind of black and white, dollars and cents. This is one of the reasons why we provide a monthly report showing the estimated tax savings of the TMS program that is provided. I may not check it every month, kind of as like a watch pot that never boils. Some months are going to be more active than others, right, based on market conditions. But a good thing to look at, maybe every quarter, maybe every twice a year, every other quarter, to see how it's performing and the tax savings you have. But, like I said, the last couple of years, over 1%. And depending on the type of investment you're in, we've seen as much as 2% in savings. So it's very impactful. It's also very cost effective. Some of our solutions, there's no cost to TMS, and in some it's 10 basis points. So you're certainly getting what you're paying for with this solution, and makes transitioning assets over far easier, and also just keeping more of what you earn at the end of the day, by taking advantage of tax loss harvesting. So that's kind of what I had in terms of prepared comments. Jessica, I'd be happy if there were any questions to kind of address those.
Awesome. Thank you, Eric. Yes, we do have some questions, and we found this to be such a crucial part for our retirees, and unwinding positions that have large capital gains where they kind of feel stuck in them because they don't know what to do and they sell everything else. And then they get to a point where that's the only asset left and they're going to have a huge tax burden. So unwinding positions and creating monthly income from it has been huge for our retirees. We do have two questions. We have, can it be used and more efficient in place of a standard IRA? Or I don't know if you want to answer that, Eric.
Sure. So could we do this in IRA? Is that what the question is? Or,
Would it be more efficient than an IRA?
well, IRAs are kind of the most efficient because the growth is tax free. So, um, this is kind of a different bucket in terms of kind of where you're getting your, when you're in retirement, where you're getting your income from. So it's a little bit kind of a different scenario. IRAs are always, more tax efficient because of that tax-free growth. You really can't beat that. But this is for your assets that you have in your non-tax, your non-qualified or your taxable accounts.
Or let's say you have those required minimum distributions and you don't need all that money, you can reinvest it and you can use this for that money to make it somewhat tax efficient, at least more tax efficient. And then
That
it also,
or I was
sorry,
going to say, just for a quick segue, maybe for our next one, because we're doing donor advised funds, and single charity funds, if you don't need that RMD, you can also give that to charity as well too, and not realize that RMD. So some other ways to kind of, be able to offset that income if you don't need it.
awesome point. Yes. And will this be better than mutual fund for improved gains and for tax losses?
Yeah. So mutual funds, one of the things where mutual funds have, they haven't been as popular, maybe in recent years, is because they aren't as tax efficient as ETFs or certainly these type of, actively managed SMAs where owning more positions. There's always and with active management, they're always changing things out. So there's almost always going to be positions that are at a loss. When you have a mutual fund, there's going to be a certain point where if you bought that lot 5 or 10 years ago, I mean, fingers crossed, right? We never get to a point where that position is going to be down 5% because it's already up like 100% or 200% from when you bought it. So at a certain point, and it's actually, there's a term for it. It's called portfolio ossification if you want to look it up. But your portfolio will get to a certain point where it really won't have losses to be able to harvest because the gains are just too high. And it would really take kind of a catastrophic event that we're all, keeping our fingers crossed doesn't happen. So there are more efficient ways to get this type of, of return. And that's why we have that average number, 1.42, 1.29 the last couple of years. Some people have had less savings. Some people have had more. A lot of it is how your portfolio is constructed and the type of structure your investment is in.
Beautiful. Good point, Eric. And as we mentioned, the next one of these is going to be about donor advised funds, which we have some people on the call who did this last year. And there's a tax benefit to it and how they all can work together. We were talking about before with the collateralized securities backed line of credit, tax management service today. Next, we have donor advised funds. And then we're going to talk about private credits for our fourth part of this webinar series as well. So thank you, Eric, so much for diving into this with us today.
You got it. Yeah, it is a complicated subject. We do have a lot of great materials. Jessica, I'm going to send it over to you. Different definitions of and how to read the proposal and the tax savings report. So, Jeff, I'll send that over to you if you would find that helpful for your investors. They can refer to that as they have use this program.
Perfect. Yes, we'll send that out with the recording of this. I know some people joined a little bit late, but the recording will go out and then we'll send off over that piece as well. So thank you, Eric, and thank you everybody for joining us today. We'll see you on our next one.
Take care, everyone.
Yeah, everybody.